Welcome to our monthly view from the Edge for August 2021. I'm Fritz Folts, the Chief Investment Strategist here at 3Edge, and with me here today, once again, as he is each month, Eric Biegeleisen, Director of Investment Research and Deputy Chief Investment Officer here at 3Edge Asset Management. And as we do at the beginning of each month, Eric and I will provide our most recent outlook for the global capital markets, which is based on our proprietary research model. As a reminder, the full print version of this monthly View from the Edge newsletter is always available on our website at 3edgeam.com. We have a lot to get to today, so let's get started. And for the middle of the summer, there seem to be a lot of topics swirling around the global capital markets these days. Sometimes it feels as though market sentiment swings back and forth from one day to the next. Now, over the course of July and now into August, we've had very strong corporate earnings season, but there's also concern that this may be as good as it gets and that we may have reached what people refer to as peak corporate earnings and even potentially peak economic growth. The labor market continues to improve, but companies, both large and small, are still struggling to solve their current labor shortage issues. And investors are also seeking to understand whether the current inflationary pressure that the economy is undergoing currently will prove to be transitory, as the Fed insists, or more long-lasting. And what if it isn't inflation that's transitory, but rather economic growth? What if, as the year progresses, inflationary pressures remain, but economic growth stalls? We could find ourselves in a stagflationary environment with higher inflation, slower economic growth, and that's something we haven't experienced since the 1970s. Investors are also attempting to handicap when the Fed may begin to taper its bond buying program, which seems like a good question since we have a white-hot residential real estate market with the Case-Shiller home price index reaching its highest reading since the index began in 1987, and yet the Fed is continuing to purchase mortgage-backed bonds each and every month. On the coronavirus front, we have both bad news and good news, with a surge in the Delta variant among the unvaccinated, but a recent uptick in the percentage of the population that is being vaccinated. Whew. So with all of these questions currently facing the markets over the coming months, let me bring Eric into the conversation, and we can start with a quick look at our 3Edge View from the Edge dot plot for August, and we can see the major asset classes that we model and what might have changed since the month of July. So Eric, over to you, sir.
Great, thanks, Fritz. As you can see from our dot plot chart here, we can see the two notable things is that Europe has moved up one notch and Japan down a notch, though both still in the positive range. We're also going to touch on U.S. equities, our outlook on rates, and gold as well. It's worth noting that the movement of the overall projections in the model, several equity model projections have been declining, while gold and bonds are elevating somewhat. And that could be instructive of a shorter term slowdown, as you suggested, Fritz, or this idea of perhaps this is as good as it gets, or perhaps the model is just signaling that markets have gotten a bit ahead of themselves in the shorter term, and perhaps a shorter period of consolidation or profit taking may be afoot. So time will tell.
Excellent. So now let's dig into some of these asset classes. Why don't we begin with U.S. equities, which continue to hover around all-time highs and seem to continue to be feeding on the abundant liquidity sloshing around in the financial system, thanks to the Federal Reserve. So what are we seeing there?
Yeah, I mean, I'm not sure I can count how many times we've noted this, but by our measure, the U.S. equity markets remain significantly overvalued as they continue to hover around all-time highs, as you noted. And to be clear, our valuation approach has a high correlation to the forward 10-year return on average for the indexes we measure. So with the advances we've seen in the U.S. markets without the commensurate increases in interest rate adjusted sales and earnings, we find ourselves with these dim prospects for average annual returns for U.S. equities over the next decade. All that said, overvalued markets can get more overvalued. As you noted, Fed Chair Powell indicated in the June FOMC meeting that the time had come to begin to consider tapering the Fed's current $120 billion in monthly bond purchases. Which is a potential negative for the markets, right? But he also indicated that it was too early for the Fed to consider raising short-term interest rates. So that's a potential positive for the markets. On net, it's probably a slight negative, though. We're also potentially going to see weaker than expected growth in the second half of the year due to continuing supply chain disruptions, labor shortages, and the continued rise in coronavirus Delta variant cases, which may collectively prove to be just this net drag on this current economic rebound that we're experiencing. And then to pile more on, we're seeing flattening yield curve measures in the U.S. We've seen the 10-year come down quite a bit. I'm sure we'll talk about that a bit as we go on here. And recent widening of our high yield credit spread measures also heightens the risk of an equity market correction in the near term.
Excellent. So let's switch geographies now and look at Japan and the Japanese equity market, which remains attractive on a valuation standpoint, but now somewhat less attractive, at least in the near term.
Yeah, I mean, we've been optimistic on Japan equities since mid-2020. They performed well last year for us and our clients, while this year the returns have been a bit more neutral. Though, as we noted last month, in local currency terms, the returns were much more attractive. All that said, while they do remain relatively favorable versus equity indices on a valuation basis, as you noted, Fritz, the recent deterioration that we've seen in these high yield credit spread measures, alongside the early signs for some potential negative investor psychology to manifest, has indicated to us and through the model that the Japanese equities are currently somewhat just less attractive now than they used to be, and hence the notch down.
Right. Excellent. And so now we'll look at Europe, which has actually improved in terms of the model. We'll look at European equities, and that's an instance where on both the currency hedged and the non-currency hedged basis, European equities have had pretty strong performance year to date. So what are we seeing there now?
Yeah, well, like Japan equities, the European equity markets remain relatively undervalued, particularly when in comparison to U.S. equities. So that's a positive. More importantly, though, what we're seeing is this continued monetary and fiscal stimulus policies in Europe just continues to be highly accommodative with no signs of abating, more so than many other regions. So that's a real big positive for the space. A sharp or unexpected uptick in inflation in the region could be a negative risk to this outlook.
Okay, let's switch from equities then and take a look at the fixed income and the bond markets. It seems like over the past months anyway, investors have just been absolutely laser focused on following the yield of the 10-year US Treasury. And along with that, though, one thing that we have seen is that real yields have recently descended into historically negative territory. So maybe you could bring us up to speed on that.
Yeah. So with the recent decline in interest rates, we've seen the model boost the short-term outlook for bonds. Though largely this is just attributable to this downward yield momentum, which can be quite volatile and transitory in nature. So it's hard to get super excited about investments in intermediate or long duration bonds. With yields now hovering around 1.2%, this incredibly low yield has a poor risk return trade-off, making these intermediate nominal U.S. Treasury securities not particularly compelling. That's something we've been noting even at slightly higher yields, right? And to look at it differently, as you noted, Fritz, U.S. Treasuries with a current nominal yield at around 120 and with inflation over 5% right now, that's a large negative real return a bond investors is locking in.
Absolutely. So that is a very good segue to the real asset market, and particularly gold, which would be impacted by these negative real rates. So maybe you could go into that in a little bit more detail.
Sure, yeah. So we just discussed real yields are negative. And in fact, the real yields, as indicated by the intermediate U.S. TIPS or Treasury inflation protected securities market, are around negative 110 basis points or minus 1.1% currently, which is the most negative real rate we've seen in this market. Gold tends to move inversely with real yields. So in theory, this decline in real yields into deeper negative territory is welcome news for gold investors. Although current investor consensus is for inflationary pressures to be transitory, should inflation prove to be more persistent and instead economic growth perhaps more transitory, as you noted in the beginning, Fritz, the U.S. economy could face this prospect of stagflation. And this would be this combination of slowing economic growth and rising prices at the same time, which is not a great recipe in general for risk assets like equities, but gold represents an asset class that could actually benefit in this type of stagflationary scenario.
Yeah, and I think it's interesting because sometimes we think about it as being binary. Either inflation is going to roar or the economy is going to roll over, and it doesn't have to be that way. You could have an environment though where economic growth slows measurably just based on the fact that these supply chain bottlenecks don't clear up for a while, and the labor force that spread between the available jobs and the people who haven't gone back into the workforce, that could remain wider for a longer period of time. So it's not binary, and so you have to, it's fairly nuanced, which I think comes through in your analysis. So thank you for that. Thanks for getting us caught up with the highlights from the View from the Edge for August. And again, if you'd like the full 3 Edge Views from the Edge newsletter for August, you find that on our website at 3edgeam.com. So that will do it for Eric and me, but we will be back once again in early September with the next edition of our monthly 3 Edge View from the Edge. As a programming note, I mentioned this last week in our Week in Review video that we will now be taking a short break from our videos for the remainder of the month of August to give all the folks who work very hard on producing these videos some much deserved time off. But we will start back up again in September right after Labor Day. In the meantime, remember all our videos are available on our 3 Edge YouTube channel as well as on our website. So on behalf of Eric and everyone at 3 Edge, we thank you for listening, and we will see you all in September.